please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
So there is that worry about EM pain point because of the strong dollar. We have to take that on board very seriously because now we could well look like a double deficit country, current account deficit plus fiscal deficit because of the very poor GST tax collections. But more on that later. First, let us savor the good news. The big story of Friday, the strong GDP data. We spoke to a whole host of economists and experts, listening to what they have made of the GDP numbers. Thereafter, we'll take a break and come back with the micros.
8.2 is still a good number. But it's like the curate's egg. I mean, there are good parts and bad parts. While I think we should all be very pleased with these numbers, especially because of agriculture and construction, two very labor-intensive sectors, we should be a little concerned that we don't go into a state of euphoria. Because my own sense is next quarter we'll be looking at something closer to 7.5%. As far as food grains are concerned, it's always hung around 2–2.5%. I mean, there's nothing. Practically all the growth in crop agriculture has come essentially from vegetables. So if you take the total GDP deflator and you correct for the low agricultural price increase, what you are getting is an enormous increase in non-agricultural prices, unacceptably high levels. So what you are talking about is not that agriculture, the farmers are making roughly zero additional income. They're actually getting negative real incomes. That's what it's saying. So when you're talking about headwinds, this is a big headwind.
My sense is that on a headline basis, the numbers which were on the GVA numbers could be actually maybe a 40–50 basis point impact, but the impact on the GDP could be actually higher than what we have estimated, and there's actually your 7.1 and 7.2% conjecture comes. So GDP obviously has been held by a stronger base, much more than even the GVA base, because we also had that indirect taxes and subsidies part which is contributing to that. If the central bank is not in favor of too much of depletion of foreign exchange reserves, it could look at other options to defend the currency if it continues to depreciate. And against that background, I think one of the possible options, textbook prescription, is foreign policy rate, is a rate hike. So that is the thing. So that we need to see whether that is the thinking, or it wants to see some of the numbers play out before trying to stem a fall in the value of the rupee if it continues to do so.
Oil at 77 this year is a negative terms of trade shock. And remember, monetary conditions are beginning to tighten or have tightened in the last few months and may tighten more if the currency is under some pressure and the RBI has to move. And the deleveraging is progressing, and that's going to have some dividends down the road, but we're not seeing credit growth accelerate sharply. So I think if we can end the year with 7.3%, which is our current forecast, I think India will be doing very well in a turbulent global environment. The 8% is in large part because you had a very weak base of the same quarter last year. But we had all built that into our forecast of 7.5 or 7.6. So the fact that it's surpassed market expectations suggests growth is really strong. I think it's easy to read the numbers and say industry is going at 10%, services at 7%, this is all manufacturing industrial led. My reading is exactly the opposite, because if you go back 4 quarters ago, the 10% industrial growth is on a base of 0.1%. In fact, in our view, the upside surprise happened on the services side, because services were contending with a base of 9.5% growth in the same quarter last year. On that base of 9.5% to grow above 7, I think was very impressive. We've been arguing for a while that some degree of currency depreciation is good, it's healthy. We've had a 6% real depreciation in the first 6 months of the year, and already in the second quarter, the drag from net trade, exports have picked up, imports are still strong, but the drag from net trade in today's GDP number is meaningfully less. It's the lowest in the last 5 quarters. So these things do pan out eventually. The more the exchange rate works, the less we have to curb aggregate demand to contain the current account deficit.